Hi, everybody, and welcome to the Middle Class Investor this week. Thanks for coming in. It is Saturday, about 2 o'clock, and as normal, we're starting here with the S&P 500. And wow, there's not much to say here about this except this is extremely bullish, blow off top, kind of bullish looking. And who knows, maybe this goes much higher from here. It looks fairly strong. So I will tell you that sentiment indicators are very, very, very overbought is the right term. Some of the indicators like the investors' intelligence indicators are at 31-year highs. And we've talked about sentiment in here and how important it is. The timing on sentiment is a little bit difficult. In other words, sentiment can remain high for some period of time before the market actually corrects and starts to move the other way. But anytime you start getting sentiment indicators that are 31-year extremes, it's really should be taken as caution. The main thing I want to point out with this graph is that we're above the channel on the long-term trend. This goes back to the 2009 low. We're above the channel on this minor trend, which you can see goes back to the end of 2016. And we're at the end of this very, very small trend right here. When I say we're at the end, I meant we've exceeded the channel. So we've exceeded the channel on all three of these little trends here, and this is what Elliott called a throwover. And I guess what we're waiting for now is for the market to close back below the trend line. So now you have to draw these trend lines very specific. You kind of have to know where the wave 4 is and the wave 2. So for example, I'll show you the larger one because that one's probably the easiest to see. Normally what you do is you connect the wave 2 low, which is right here, and the wave 4 low, and then you extend the channel up. And I don't know why I didn't do that. Did I? I did. Okay, I did it on a log scale. What I should have done, let's just do it real quick. Just to maintain constancy, should have done it on the arithmetic scale. So I'm going to connect the wave 4 low there and the wave 2 low, and then you extend up to the extreme of wave 3, which would be right in this area right in here where my cross hatches. So I'm going to click right there, and then so now you can see here's the channel, and you can see we're above the channel on the long-term chart, which goes back to the 2009 low. In other words, this is the wave 2 of the 2009 low. This intermediate term, which is the end of 2016, you can see that we're above the channel there. And then and even on this very, very short term, I'm going to have to zoom in more. Let me go back to a 5-year. You can see that even on this very, very short term, we're above the channel. So what we're looking for is we're looking for the market to break down back below these channels. So once really this intermediate channel is the key because it's the one that's highest, right? So once we break down through this, we should come all the way down through this intermediate channel, which then would obviously break the smaller term, the very minor term channel, and then also the longer term channel. So once this blue channel is broken, unless this goes much further, and the blue channel could be broken and it could just bounce off this top line here, but more than likely, we would see this to start to break down and come down below this channel. And once it closes back below this channel, then that should mark the end of this. Now, again, sentiment can remain high for a long period of time, and certainly if you've been sitting on the sidelines, you're probably kicking yourself. That's our bird. that noise. If you've been sitting on the sidelines, you're probably kicking yourself because there's all kinds of stuff on TV all the time about this is the greatest market ever. You got the president talking about it, and just a lot of people talking about it. So, and that's part of trading and investing is you have to make those decisions. Let's look at some of the other markets because there are some important. Let's look at volatility real quick. A lot of talk about volatility. Not a lot of intelligent talk about volatility, but a lot of talk about volatility. And you can see this trend line. I don't know when I drew this trend line, a long time ago. Let's see when. Well, I guess I redrew it at some point. But this trend line has been more or less here for a long time. I redrew it at some point, but you can see that it's actually holding every time we kind of get up above there. Volatility sells back off. So at some point, volatility is going to pop through here and then continue to start moving up. So we just have to wait and see when that point is. But I don't know. This is like the second longest bull market in history. Most of the parallels to this market are 1929 parallels. So obviously, many of you don't have to have me remind you, what happened in 1929. So I don't know if that means anything. Like if that means that this is going to be like 1929. There's no way to really know that. But you get 31-year extremes in sentiment. You got a lot of parallels to 1929 run-up. That can't be a good thing. So, okay, now we're on the 10-year Treasury. This is the 10-year Treasury yield. So this moves. So what's happening is bonds are going down. The 10-year bond goes down. The yields go up. Okay, so the cost of borrowing money is going up. And of course, we started talking about this when we got a breakout of this downtrend line a while back here in October, and we kind of bounced down and retested a couple times, but then you can see it's starting to kind of move up, starting to accelerate, and at some point, and this is done going down. This is up. Okay, this is going to be nothing but up, and at some point, this upward momentum is going to start putting downward pressure on the stock market and probably end the rally. And but there's no doubt that the bond market, even Bill Gross, who used to run, what was the name of his company? Real famous bond investor. I think about 2 weeks ago, maybe after we broke these highs right in here, just below 2.5. So maybe right here, right at 2.5%. Once he like right in here somewhere, he basically said that the end of the 35-year bull market in bonds was over. So he's on record as saying that. Now, look, Bill Gross could be wrong, but there's other places that I'm tracking this, and they pretty much agree. So the 10-year Treasury is done going. The 10-year bond is finished going up, and we're going to start now a long-term bear market. So it basically, the 10-year Treasury bond went up ever since interest rates peaked back in 1982 or whatever it was. So ever since 1982, we've been going up, and the bond market yields have been going down. Cost of borrowing has been cheaper and cheaper and cheaper. And what a couple of these guys are saying, Bill Gross included, in Prechter, Bob Prechter, they're saying that trend has reversed and is starting to move in the other direction. Now, usually, so an increase in yields, remember, is the same as bonds selling off. And what do we know about markets that sell off? Well, they sell off faster than they melt up. Okay, so you've got a situation now where the bond market is selling off, i.e., yields are going up, which likely means that yields are going to go up very rapidly. And this is going to be very, very stressful on all parts of the economy, and even including government. Right now we spend about $500 billion a year in debt service. and that's at record low interest rates. You double the interest rates from here, and obviously, we're going to be spending $1 trillion a year in debt service. You double again, and you're talking about $2 trillion. So what is that? Doubling again is from here to 5, and then from 5 to 10. So maybe we don't get all the way to 10 here in the next few years, but that's going to become a problem if quote unquote we're wasting $2 trillion a year just to service our debt. Nobody's getting any Social Security checks. There's no welfare. There's no nothing. That's just $2 trillion going to in the form of interest, dividend interest, or yield interest to bondholders. Okay, so that's eventually going to become a political problem. So watch that very closely. It's a very serious event, and it's going to have major repercussions for every single person living in America. All right. Now, if that wasn't bold enough, actually, I don't have anything to top that. That's going to have to be bold enough for you. All right, let's look at the short-term yields. As you can imagine, those are still going up. We had a little pullback here and kind of traded along this trend line and then took off again. And we could get another little pullback like this, or a consolidation maybe where they just go sideways and then up again. Clearly, the Fed is not raising rates. The Fed rate is not 1.4%, even though this chart shows 1.4%. So the Fed is down here somewhere at 1%, and they're following rates. So as this ticks up, the Fed will raise rates. It ticks up, the Fed raises rates. Maybe I'll look and see if I can't find a chart that shows that. I think I showed a video on here that shows a very detailed chart. But the Fed is trying to give the perception that they're the control of the economy and they control rates. The truth is they really don't. They could control rates, and they were doing some of that during QE, because what they were doing. Let me just describe QE in case I haven't done that before. QE, quantitative easing. What was happening is the Treasury, the United States Treasury, would issue a bond. Okay, the Fed would take that bond, and normally they would go sell it to investors, and they were doing that. Still, it's called open market operations. You hear them talk about open market operations all the time. What was different is the Fed was then also, even though think of the Fed as the broker selling the bond that was created by the Treasury. So the Treasury creates a bond, a piece of paper, gives it to their broker, the Fed. The broker then sells that piece of paper for their obligations. Okay, they sell obligations to the market, and the market money flows in for those obligations. Money flows into the Fed passes the money back to the Treasury. Now, what was different about QE is not only was the Fed outselling treasuries to other market participants, but they were coming into the market themselves and buying up treasuries. Now, you might ask yourself, with what money? Well, with just digitally created money, just dollars in accounts. They would say, we want to buy $1 trillion, and the money would be just created out of nothing. They have the power to create money, so they would take the money, create it, and then they would buy the bond from the Treasury with money created. So that's quantitative easing, and that is very, very destructive for the dollar and our economy long term. So, hopefully we don't have any more of that quantitative easing. That leads to the problems that, say, Venezuela is facing. So hopefully we don't have any more of that. But if the Fed was, let's say there were no other buyers for U.S. Treasuries except the Fed. Well, the Fed could buy enough Treasuries to keep the yields down. That's really the only way they can control interest rates. But out of the 100-year history of the Fed, they've never done that except in this quantitative easing program. So this is what happened over the last 6 or 8 years is pretty unprecedented. I mean, in the history of the U.S. economy. So. Could they go do more of that? Sure, they could, but you'll just watch their balance sheet. Their balance sheet will grow if that happens. And right now it's about $4.5 trillion. So if you start to see the Fed's balance sheet go from 4.5 to 5 to 6 to 8 to 10 to 20, well, then you're going to know that they're just monetizing the debt. They're creating money out of thin air by the sleight of hand of making a bond. A bond is nothing more than another piece of paper. It's an obligation. It's a contract. Okay, that says if you give me $1 today, I'll give you $1.10 tomorrow. That's all a bond is. Okay, so anyway, we got to keep a close eye on this. It's very, very important that this doesn't get out of hand, and it's likely to get out of hand, but getting out of hand is going to be bad for all of us. So it's important to keep an eye on it. All right, let's take a quick look at some of the other markets. Let's look at the United Kingdom. Let's look at the United Kingdom. Okay, you can see here we've broken above, and we've closed now 2-3 times above this this area here. So what we want to do now is we want to create a new box off of this high here, off this pivot high, and you can see that we're almost there. So maybe the UK makes it up into this area, which is not much further, and then starts to roll over. Let's look at Japan. Japan, I don't know. Japan's on a different planet. They're on the quantitative easing planet. That's why their yields are negative or very nearly negative. So essentially what's happening here is a lot of this increase in the Japanese market is just inflation. So if I take a number like 10, okay, the number 10, and I divide it, let's just do that. Let's take 10, and I divide it by 2, it equals 5, right? Okay, but if I take the number 10 and I divide it by, let's say, a smaller number, let's say 2, then that equals 5, right? So, or excuse me, I did the same thing. If I take I meant to do this one, I did this wrong. I meant to do this and put 2, and then do this one, and then make it 5. So what happens? So think of this number over here as the market, and this is the dollar. So if I take the dollar, and I divide it by a number, and I get a number, okay? But if all I do is take the dollar and divide it by a smaller number, then it makes the market go up. The same thing happens when you devalue the dollar. The apparent, the chart goes up, but the real value of the market doesn't go up at all. It's just it goes up only in terms of dollars. If you sold some of that stuff in the market and you went to try to buy something from another country or whatever, it's the same thing with Venezuela. The reason Venezuela is having so much trouble is because, well, for one thing, Venezuela they don't have a very complex economy. So a lot of their goods and services they have to get from abroad. Well, if their money's not worth anything, people from abroad don't want to sell them anything. See how that works? But if Venezuela did have an economy, and all that was happening is the bolivar was getting less and less valuable, the market would look like it was going straight up. That's because it's divided by bolivars, and the lower the value of the bolivar, the higher their market would go up. So I hope that's not too confusing, but that's similar to what's happening in Japan. You've got Japan monetizing a great amount of debt, which is putting more and more yen in the economy, and because their market is expressed in yen, it's going up. So it's the wealth effect, but it's really not true wealth. Okay. All right. Germany's looking like it's maybe close to a place where it might turn here. Yeah. The thing that's weird about Germany is, you have this huge, kind of drawdown right here. So this could be similar to our market in that, you get this last thrust up going on here. We'll just have to wait and see. This is a pretty big week. Last week in Germany was a pretty big week. So That that's a close above our box. So we'll just have to wait and see. That's looking pretty strong. I mean, maybe Germany. I'm not familiar with Germany's debt or how much, what their debt to GDP is or anything like that. But they may not have the same kind of problems because the euro. If you think about the euro, there's limits to how much countries can borrow and things like that. So it could be that Germany's in fairly good shape relative to the euro. So that may be what we're seeing there. All right, let's switch over to our other charts here. Let me close this. Guess we'll do like that. There we go. All right. So here's the. Let me put it on a week. I haven't changed this. So this is the market, and you can see wave 5 is extended. So here's kind of the way Elliott counts the waves. You have 1, 2, 2 here. This is all 3, 4 in this huge consolidation, and this has all been 5. And you can see the channel here. It's real easy to see the channel. It's real easy to see where we're above the channel. And when we get it close below that channel, we'll probably come all the way back. We'll at least come back to this 17,400 area. But mostly what I look at here when I come to these charts is I look at gold. And, a few weeks ago we had these several different scenarios. It looks like the one that's playing out is the first one. So we're likely to just move straight up into this area and then come down. Or maybe come down a little bit and then go even a little higher. But gold is really strong. And I wouldn't expect gold really to slow down until you got above this area here. So maybe, and probably even further, maybe, gold's probably headed for 1390 is my guess. So silver and gold are they've been trading differently. And, I'm not sure. I haven't been watching gold and silver long enough to really know why that happens or what's the result of, what happens after that happens. But I would say, here we are right in the middle. So, is it going to come down again and then go up or go up from here? I think you have to wait until you get closer to these extremes. You have to, you want to buy silver here, you want to sell it here kind of thing. And you could really say the same thing about gold. You want to buy gold down here around this until this thing breaks, until the market comes out of this range right here, this yellow range. Let me zoom in a little bit, get a little better look. Until the market breaks below this range right in here, or above this range right in here, you just kind of want to trade it in between. So when it gets here, you become a seller. And then here you can become a buyer, so on and so forth. And then, like I said, eventually it'll come up to here, and then, obviously you want to take a sell position and try to trade it down, but you likely this zone right here will not hold once this makes another run up and takes out these highs. Likely what will happen is it'll turn here, just like I've got drawn here, but this won't hold as support. It'll break down through that. Okay, hopefully that's not too confusing. Let's look at crude oil. Crude oil has been very strong, but you can see it's right in the middle of our resistance zone and starting to show a little weakness here. So I would say crude oil is probably, it might chop around here a little bit and maybe even make a new high, but I would say it's going lower from here, and I would say at least to this area here. So we'll look on the chart and see what that area is. That area is about 50. Let's call it 54.5. So I would look for crude oil. Again, it could chop a little bit, but then roll over and go down to at least that 54.5. But again, I would say crude oil is probably a sell up here and probably a buy down here and a sell here, so on and so forth until it breaks out of these ranges. Let's see, do I have the euro? Yeah, here's the euro, US dollar. Euro continues to show some strength. I'm going to zoom in on this one too. But again, it's in our little zone here. Well, hold on. Done. Go a little higher. There we go. Get it in the middle of the page here, kind of. Sorry, I'm having trouble getting this exactly where I want it. Okay, right there. So you can see that the euro, look, I mean, if you look, it looks like kind of a 5-wave move right here. You can kind of 1, 2, this is all 3, and 4 back to here, and then this is looking like 5. So, you know, maybe this is 1, 2, 3, and then we're going to have, you know, kind of a 4 and then a 5. But the euro, definitely, you know, unless you're day trading the euro, you don't want to be a buyer here. You want to wait. Again, it could pull back a little bit and then rally to a new high, but then more or less this zone is going to hold, and we want to be a seller here on the euro, probably down into this area initially, and then take another look. Maybe look for an A, B, C up to here, and then be a seller again. So hopefully that makes sense. British pound. Well, let's see. What was it, the Canadian dollar, or was it British pound, US dollar is what we're looking at? So we never did really get a pullback in this. This looks pretty strong, and you know, now it's trading above our zone here. So not really sure what to do with the British pound. Originally, I was hoping that somewhere like in here it would pull back into this area and then create a buying opportunity for us right here. For that, but now, you know, we got a pullback, but it didn't go far enough, so never broke this trend line, which is interesting. I mean, if you look at this trend line, maybe what you do is just hang on with the British pound and then wait and see if it breaks this trend line. If it breaks this trend line, it's probably coming back, you know, some percentage of this move, you know, either into this area or into this area down here. Okay, so between, you know, whatever that is, 1.3 and 1.2, something like that. Probably when the dollar, you know, right now the dollar is just really weak. I can't show the dollar, but the dollar is, well, I'll show you where the dollar likely is in its move, and I'm going to oversimplify the drawing. Let me just create a little white or black space out here. So the dollar looks like this. You got it kind of a down, an up, a down, and this isn't quite finished, so we're going to need, you know, some sort of up and then another down. So the dollar's like right here. Okay, so the dollar's probably going to rally, which would pull this back some. So as the dollar rallies up this way, this would come down this way, and then the dollar would make its last move down. So this is going to make another move up. So I would wait on being long the British pound until the dollar, you know, finds a bottom and then starts, you know, kind of moving back up. All right. In general, you can say that for anything where the US dollar is in the denominator. So the British pound, US dollar, the Canadian, is it? I think the CAD goes first. I can never remember what goes first. Nah, it's US dollar CAD. So USD CAD is just the opposite of the British pound. So you might see the USD CAD continue to fall, and we had this kind of line here. You might see it fall down into this area, and then when the dollar reverses and starts going back up, you know, you could see the CAD, you know, start to move this way. Okay. All right, I hope that's not too confusing for everybody. Let me go back to, just for grins and giggles, back to the S&P 500 chart. And again, just, you know, right now, you know, if you haven't been in this market, I mean, you're kicking yourself, right? I mean, that's usually how that goes, and everybody, you know, is making money and they're just so happy and all this other stuff. But I'm here to tell you the pain is going to come. The pain is going to come from this move. I mean, this is an unbelievable move right here. I mean, we had I mean, look at that. That's a huge white candle. That is blow off looking for sure. So, you know, we might have a little bit of down, maybe a little bit more upside, you know, but there just can't be much. I mean, there could be a lot more. I mean, who knows? This thing could go to 5,000 before it stops, but I don't think that's likely. And certainly given, you know, the maturity of this pattern here, you know, this, let me go back and look at it on the chart section and just look at the S&P. I mean, the maturity of this pattern here. So, you know, 1, 2, 3, 4, 5. I mean, here's your 1, here's your 2. This is all 3, 4. I mean, this pattern looks very mature. I mean, I can move this up, you know, here, and move this one up here. But this pattern looks very mature. If you measure, you know, if you were to measure this move and compare it to this move, now the fifth wave is longer than the first. No matter how you measure the first, if you measure the first from here to here, or if you measure the first from here to here, which, you know, the most accurate way is to measure it to here, but either way you measure it, now the fifth wave is longer. So, you know, you might be asking, well, when is all this wrong? And it's a good question. When all this is wrong is when, let me pull up a line here. If you take a line here from the bottom of wave 2, so or let's just call that the beginning of wave 3, okay, and you go to the end of wave 3, which is like right there, okay. If this fifth wave exceeds this distance right here, so let's see, how do we do that? Let's make a line. Let's make a different kind of line, kind of at that angle. How about that? That looks pretty good. And let's go back to this. And now let me just take this and move it to here. See how that can't, I mean, we're going to know pretty soon whether we're wrong, because this yellow line terminates up here close to 2,900. And this fifth wave cannot be longer than 3 if this is a 5-wave move. Okay, so we're very, very close to the end here, unless this whole thing is wrong. And if the whole thing is wrong, then so be it. We got to come back and reevaluate. But right now we've got, let's see where this thing ends. We got this thing ending at 2880, and we're at 2810. So another 70 points, which is not insignificant, but 70 points is not the beginning. That's another great point. You know, 31-year extremes in sentiment and blow off tops and exceeding the upper channel. These are not things, I don't know how to be more clear than this. These are not things that happen at the beginning of a bull market. So if you are listening to somebody and they're telling you this could go on for another 2 or 3 years, I'm here to tell you right now, they are wrong, okay? There's no more wrong than you can get than making a statement like that. So just be very, very careful who you listen to. Mostly what you have driving this is a lot of emotion. The way the investment market works, the way the advisor market works. You know, if you know, person A is with advisor B, okay, and they're talking to person B or person number 1, and they say, hey, my advisor's made me 10%, and this person over here goes, oh, my advisor's only made me 6%. So what ends up happening is these advisors, it becomes, it's a cost penalty to them to remain out of the market too long. So maybe they were bearish right in here, and, you know, somewhere in here, okay, and then they just finally gave up and got back in. Well, that's fine, but then they need to be able to get out. You know, they need to pick a place where they can get out. And most of them, of course, can't, because it takes them months and months to build these positions. So you just have to be very, very careful. Be careful who you listen to. Even me. I mean, check check what I'm saying out, but don't go to your local Edward Jones guy and ask him, because he's not going to, he doesn't know any more than any other Joe does. Okay. All right, everybody. That's it for this week. Appreciate you coming in. When this thing starts rolling over and people start losing a lot of money, I want you to share these videos with people. Let's not all lose money together. I mean, it's okay to make money together as this moves up, but let's not, rising tide raises all ships. Well, a falling tide lowers all ships too. So we need to make sure that some of your friends and family get to keep these gains before this sells off and crashes. Okay. And then next week, depending on what happens, I want to talk a little bit about, how sometimes the market can be highly translated, where the trend can be highly translated, what they call right translated. In other words, you have a situation where the sell-off, when it does happen, can be quite steep. I mean, instead of getting a nice, gentle kind of downward thing like this going, you could have a situation where hold on a second. You could have a situation where this thing just goes like this. Okay, and there's literally, maybe over 3 or 4 days, or maybe over a couple of weeks, and there's just no time to get out of this. Okay, so that happened in 1987, and we have similar kind of setup happening now. Okay, all right, everybody, thanks for coming in this week, and we'll talk to you next week. Bye bye.